the US Federal Reserve announcing its latest decision on interest rates. We're going to go straight to Richard Crest as we wait for those numbers. And Richard, we are expecting, I think it's fair to say the markets are expecting rates to be unchanged. What are you seeing?
We've got exactly that. Rates have just been announced. Rate remains unchanged. The Fed funds rate stays at 4.25% to 4.5%. So that was widely expected. That's what the Fed had led the market to believe. What we're looking for is to see exactly who dissented, how many dissented. There were two dissents, which came through. I'm just trying to get the names of the dissenting. Bear with me one moment.
No worries. As you look for the names, Richard, I know that the two of the Fed governors that were potentially going to dissent was Christopher Waller and Michelle Baumann, right?
I wonder if it's the same. They were the ones that did. Here we go. I've got the statement now just been printed in front of me. Voting for the policy, the chairman, blah, 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 blah. Voting against the decision, Michelle Baumann and Christopher Waller, who preferred to lower the target rate by 1/4 point at this meeting. So this is interesting because much is made of the fact that it is rare, I think you've got to go back several decades, to get two dissenters against policy of the chair. The chair never wants to be in the minority, but here you have two dissenters. And I think we can make a lot of this or nothing, because we know they are going to cut rates, and they will cut probably in September and twice before the end of the year. So it's really not a question of if, it's a when. And Jerome Powell just doesn't feel now is the moment. I've got the statement here now in front of me. Sorry, go ahead, Isa.
No, I was going to ask you, yes, maybe we're reading too much into this, Richard, but it does speak to the division within the Fed and within the US government, of course, who has been calling President Trump for Powell to act. And he's been very vocal about this.
Yes, he has. But there's a huge gap between what the president wants and what's going to happen in any case. The president has said he believes policy rates should be down at 1%. Well, that would be emergency rates in times of crisis. At the very best, we're looking at maybe 0.5, 3/4 of a point off over this period in the short term. The US economy does not need monetary stimulus of the sort of 1 or 2%. It's growing quite nicely at around 3%. We got the growth numbers this morning. They were better than expected. We know that unemployment is low. So both sides of the Fed's mandate, price stability and full employment, they are fairly evenly balanced at the moment. And now it's just a question of tinkering with the policy rate, lowering it to give that little bit of extra oomph to an economy that's already doing rather well.
Yeah. Let me ask you this, because according to CME Watch Tool, I think there's a 64% probability, Richard, of a 25 basis point reduction in September. Just explain to our viewers why then. What data are we looking for to trying to clarify the state or the health of the US economy?
There are two real. Think of it as being two bunches of information. The first is under jobs numbers. We're going to get that at the end of the week. We've got the GDP number. We've got inflation numbers. So we're getting a really good range of data that shows the US economy is humming along nicely and can afford to have a rate cut without too much risk of increasing inflation. But what we're also getting is greater certainty on tariffs. Now, we now know the EU, massive exporter to the US, 15%. We know the China deal is going to be extended in some shape or form. We know what other major exporters' tariff rates are. So we can extrapolate that data into inflation, into growth. We sort of, Jerome Powell has said, the tariff data so far has all been skewed because of front loading. Get the goods in before the tariffs. Well, now we can have a longer term view because we know what the numbers are going to be. That certainty can be put into the data. The models will tell them, is this inflationary? And therefore, safer ground. It's all about risk, remember. Balance of risk, Isa. And the balance of risk takes you into safer ground for September. 1/4 point. Take it to the bank.
And the Dow Jones, Richard, pretty flat. I mean, this is very much a decision the markets were expecting. Of course, we expected to hear from Jay Powell in 25 minutes. So, of course, that is going to be important what he says. Go ahead, Richard.
The question for Jay Powell will be, all right, you've got two troublemakers who want you to cut now. Is this going to influence you? He's going to tell us that he's not influenced by the president. He's influenced by the data dependent, bish, bash, bosh, on we move.
We shall see how he defends that decision. Richard, as always, good to see you. Richard, we're back with Press Meets Business a bit later. So I want to go straight to Washington. Jay Powell speaking. Let's listen in.
In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Steve.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea of what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still. So you're right. It's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period. But we're still, a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely, effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come, as well, looking ahead.
Neil.
Hi, Mr. Chairman. Neil Irwin with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because if it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you asked about the June SEP, I wouldn't, that you're right, that's what it says, and that may well, I couldn't point to it 6 weeks later.
You've been listening there
to
to Jay Powell. As you can see, a decision was made in the last, 44 minutes, of course. Interest rates haven't remained unchanged for the fifth consecutive meeting. He's been answering questions. We know in the last 44 minutes also that there was dissent within the ranks and 12 members voting, two of them dissenting. And it's the first time, in fact, they have dissented in 32 years. Jay Powell's being asked a question about the arguments that he found most compelling for the dissent. He also spoke about said they did not made a decision about September, about cuts in September. This, even though we've heard from President Trump today that he wants to see rates change in September.